Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate speak to reveal the truth. Today we are diving into TransDigm Group's latest financial report, and let me tell you, they have been busy buying companies. It sounds like they are on a serious acquisition spree, which always makes things interesting. Alright, let's get right into it. TransDigm Group Incorporated is a major player in designing and making aerospace parts, especially for the aftermarket, which means parts for planes already in service. Looking at their balance sheet, we see their total assets have grown to over $23 billion by the end of December 2025. That is a significant jump from over $22 billion at the end of September 2025. This growth is mainly fueled by acquiring new businesses. One of the big numbers reflecting these acquisitions is goodwill, which has jumped to over $11 billion. Goodwill is basically the premium a company pays for another business above its identifiable tangible assets. It shows how much they believe in the future earnings potential of these new companies. Their other intangible assets, which include things like patents and customer lists, have also seen a good bump, now standing at around $3.8 billion. This growth in both goodwill and intangible signals that TransDigm is actively expanding its portfolio through strategic purchases. Now let's talk about their sales and operations. For the 13 weeks ending the 27th of December 2025, they reported net sales of about $2.3 billion. That is a solid increase from around $2 billion in the same period last year. However, their cost of sales also went up significantly to $933 million from $771 million. This means that while they are selling more, it is costing them more to produce these goods. The percentage of sales that goes to cost of sales also increased slightly, which management attributes to the impact of recent acquisitions. Despite the higher costs, their gross profit still grew to over $1.3 billion. But if we look at it as a percentage of net sales, it dipped from 61.6% to 59.2%. This is something to keep an eye on, as it means they are making a little less profit on each dollar of sales compared to the previous year. Selling and administrative expenses also rose to $254 million. This increase as a percentage of sales is largely due to integrating those newly acquired businesses. Now for the big one, interest expense, this jumped significantly from $378 million to $475 million. This increase is mainly because they have more debt and have seen a slight rise in interest rates and a decrease in interest income. This higher interest burden is a direct consequence of their aggressive acquisition strategy and increased borrowing. All these factors combined brought their income from continuing operations before income taxes down to $572 million, compared to $619 million in the prior year. Ultimately, their net income for the period was $445 million, a decrease from $493 million a year ago. This translates to earnings per S-share of $6.62, down from $7.62 in the same period last year. This drop in earnings per S-share is a direct result of the higher interest costs and the impact of acquisitions. Let's look at how their different business segments performed. The power and control segment is their biggest, with net sales of over $1.2 billion. This segment saw a substantial 19% increase in sales. The airframe segment also grew, with net sales hitting just over $1 billion, an increase of about 8%. And their non-aviation segment, while much smaller, also showed strong percentage growth, more than 21%. Across all segments, their EBITDA as defined, which is a measure of operating performance, was over $1.2 billion. This shows that their core businesses are still generating a lot of profit before accounting for things like interest and taxes. Now, about their financial health and liquidity, they ended the period with a very strong cash position of over $2.5 billion, though it decreased slightly from $2.8 billion. But here is where it gets interesting. Their total debt stands at a massive $30 billion. This is a huge amount, reflecting the financing of all these acquisitions. Interestingly, they bought back over 85,000 shares of their own stock for about $106 million. This is a common strategy for companies to return value to shareholders, or to offset dilution from stock options. Despite all the buying and selling, their operations are still generating a healthy amount of cash. They brought in $832 million from operating activities, which is more than the $752 million from the previous year. However, the investing activities show a massive outflow of nearly $1 billion, largely due to acquisitions like Simmons Precision Products and others. This shows just how aggressive they are in growing through buying other companies. Financing activities show a net outflow of $141 million, mainly due to stock repurchases and dividend payments, which is much less than the nearly $4.6 billion outflow in the prior year. That was heavily influenced by a large dividend payment. And looking beyond December, they have even more deals in the pipeline. They've agreed to buy Jet Parts Engineering and Victor Sierra Aviation Holdings for about $2.2 billion. Plus, they are acquiring Stellant Systems for another $960 million. These are massive deals happening right after the reporting period. So, what is the verdict on TransDigm Group? On the positive side, their core businesses are performing well, generating strong sales and healthy operating profit before interest and taxes. Their acquisition strategy is clearly fueling growth, expanding their reach and product portfolio significantly. They also have a rock-solid cash position, which is reassuring given their significant debt. However, there are some key weaknesses to consider. Their debt level is alarmingly high, nearing $30 billion. This puts a heavy burden on them, as seen in the sharp increase in interest expenses. While they are managing it for now, any significant downturn in the aerospace market or a rise in interest rates could put serious pressure on their finances. Furthermore, the slight dip in gross profit margin as a percentage of sales, while currently small, indicates that the integration of acquisitions isn't immediately boosting profitability on a per dollar of sales basis. They need to ensure these new businesses become profitable quickly. Looking ahead, TransDigm's strategy is clear. Grow through acquisition. If they can continue to find and integrate businesses effectively without over-leveraging themselves further, they could see continued strong growth. But the risk is that the debt becomes unmanageable. It is a high-stakes game they are playing. They are betting big on the future of aerospace and their ability to make these new companies profitable. What do you think about TransDigm's aggressive acquisition strategy and their massive debt load? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe to Corporate Decoder for more insights like this. And for deeper discussions and to connect with other finance enthusiasts, join our Discord community linked in the description. Thanks for watching, and we will see you in the next episode.